For decades, society has handed us a very specific script. You work for 40 years, put a little away in a retirement account, and eventually, when you are too old to keep working, you get your life back. But if you look at the raw numbers, buying back your freedom does not require 40 years of labor. Through pure math, it can be done in exactly 10. We usually picture early retirement as extreme luxury, private jets, resorts, and yachts. That distorts the actual goal. Real wealth in this context is simply time. It is having absolute control over what you do with your day, from the moment you wake up. To reach that point, you have to build a mechanical financial system that generates enough consistent income to cover your living expenses, completely independent of your physical labor. The moment that passive income exceeds your monthly burn rate, you no longer have to trade your time for a paycheck. Retirement is a specific mathematical threshold. If you sit down and tally up typical necessities, rent and groceries, transportation and healthcare, a comfortable life costs around $3,000 a month. That translates to an annual requirement of $36,000. This diagram illustrates the safe withdrawal rate, commonly known as the 4% rule. It outlines how an investor can continuously extract a 4% slice of income from a portfolio, while the main body replenishes itself. Applying this backward, to safely pull $36,000 a year indefinitely, you need a total portfolio size of $900,000. Amassing nearly $1 million from zero in exactly 120 months is a terrifying calculation. It is an incredibly steep climb that forces you to ruthlessly reevaluate every dollar you earn. The only way to hit that $900,000 target in a single decade is by leaning heavily on exponential compounding. In the first few years, the monetary growth is agonizingly slow. By year 7 or 8, the returns begin to generate their own returns, creating an explosive upward curve. Plotting this curve based on average market projections of 8% or 10% traps many amateur investors. Those advertised returns look great on paper, but they completely ignore the economic forces quietly siphoning your money away. This chart demonstrates the damage of those silent killers. If you start with a standard 8% market return, you immediately lose an average of 3% to inflation. Taxes slice off another 1%, and management fees drag down another 0.5%. Your actual purchasing power is growing by a very thin 3.5% real return. Extremely safe assets like government bonds often yield negative real returns after inflation. To hit the 10-year target, you need investment vehicles that historically outpace these killers, like broad market index funds, which historically average closer to an optimal 7% real return. Every fraction of a percent matters. Surviving a condensed 10-year timeline requires filtering every financial decision through one metric: protecting and maximizing that specific real return. Let's run the math at that 7% real return. This graph plots the trajectory to a $900,000 portfolio over 10 years. To make the line connect to the peak, it demands a monthly investment of $5,500. For the average earner, a $5,500 monthly contribution is mathematically impossible. It exceeds their entire take-home pay. Confronted with this raw number, most people assume early retirement is a myth and abandon the idea entirely. But the target is highly sensitive to lifestyle. By ruthlessly cutting your living expenses down to $1,500 a month, the required portfolio drops from $900,000 to $450,000. Instantly, the required monthly investment shrinks to a much more manageable $2,700. If that lower threshold is still out of reach, you pull the income lever. You build high-value skills, negotiate a higher salary, or launch a side business. You generate new cash flow solely to bridge the remaining investment gap. Retiring in 10 years depends on the gap between earnings and spending. Success requires widening that margin until the surplus fuels the entire system. The finalized 10-year roadmap requires optimizing your life to the point where you can reliably funnel between $3,000 and $4,000 a month into low-cost, diversified index funds. Relying on willpower to execute this roadmap guarantees failure. Over a decade, market crashes will cause panic, unexpected emergencies will arise, and human emotion will tempt you to skip contributions. To survive, you must remove human friction entirely through strict automation. This schematic details a secure financial system. Your paycheck lands, and before it even hits your checking account, the funds automatically split off into separate secure pipelines, directly feeding your index funds and aggressively reinvesting any dividends. Wealth accumulation at this speed requires engineering a rigid environment where making the optimal choice happens by default. Buying back your time requires a heavy upfront payment. You must trade the comfort of immediate consumption today for the guarantee of absolute freedom tomorrow. Delayed gratification is the unforgiving currency of this transaction. Every dollar spent on an unnecessary upgrade carries a high opportunity cost. You're removing a stone from the foundation of your freedom. Even if you miss the rigid 10-year mark, even if life happens and it takes you 12 or 15 years to hit the target, you are still buying back decades of your life compared to the traditional societal path. The mathematical discipline required right now is painful, but enduring that strict discipline today is the only reliable way to avoid trading the entirety of your healthy life for a paycheck.